Welcome to the Broken Pie Chart Podcast, episode 337. I'm your host, Derek Moore. With me once again, back on the program, is Mike Snyder, Director of Trading at Zega Investments. Mike, what happened? You couldn't get over the hump today with the S&P, almost an all-time high?
As hard as I stared at my screen, it just wouldn't do it. Just would not do it.
I think a lot of people are staring at their screens, though, thinking we should be in a 5 or 10% correction. Like, this flies in the face to everyone who's wishing the market down, right? Like, don't fight it. Just shut up and take the gains sometimes.
Yeah. I mean, that's kind of why I think it keeps going up, because everyone hates it.
Do you think option positioning has anything to do with, we know that options volumes, and didn't you read something that the SIBO hit an all-time high again? Was that you told me that?
Yeah. I think their index options business I read was up like 19% or something. And, short-term, weekly, and zero DTE options are being traded at levels never seen before. So it's not just the volume, it's also the time until expiration.
I mean, here's the thing. I mean, just because options have a low time to expiration, like, it doesn't mean that those options will come off. I guess where I'm going with this is sometimes people look at, okay, all these options are coming off. When they come off, the market makers will have to take off their hedges or take off. But I think a lot of this stuff is sort of in perpetual motion. I don't know that. Maybe the SIBO's done a study on that, or maybe they should. But what do you think?
I'd love to see that study. But yeah, you got to think that the big volume, this is a consistent strategy that's being, rolled either daily or weekly, depending on the expirations. And it's not just a short-term bet that they're putting on and taking off at expiration, right?
At what point, now this is one of the criticisms of the options market, but at what point are so many options traded? And I don't think this is a problem right now, but critics would say so many options are traded. And basically, as options are being traded, that just determines what happens with the stock because of the market maker positioning. But I don't know. I mean, like the SIBO, I think they did a study on zero TTE options, and I believe they said it was pretty even on both sides. I don't know if you saw that, but I mean, options market activity definitely has some effect on stocks, I would say.
Yeah, I think especially shorter term, I think, it can create bigger swings in the market and in individual stocks. I think long term, the fundamentals are still driving returns, but short term, when you see big intraday swings, that could play a huge part in that.
I love that you brought that up, though. Over the long term, maybe it doesn't matter. I mean, if we drew a chart of the growth in earnings, or even the growth in forecasted earnings, really it's the forward earnings that markets trade off, and the S&P 500, I mean, they pretty much trace each other up and to the right over time. So I agree. Like, I know people are critical of the options market, but honestly, have you seen any deviation for a very long period of time between the forward estimates and the S&P 500 performance? I mean, I don't think so.
No, I don't think so either. I think it is an intraday thing where you see more volatility, but yeah, long term, I don't think it's impacting returns whatsoever.
I mean, the counterpoint is, didn't we just go through a period where we didn't have a 1% move up or down for a long time, and we're at record options volume? So
that's true.
All right, I want to talk about the 2009 bull market compared to this one. And I think this is Ryan Dietrich had tweeted this out. It is a chart of the bull market from March of 2009 to February of 2020. And you kind of start in years, so year zero. And then what he did was he said October 22 to the current. The audience can't see this, but to paint the picture, the line from the first one, March 09 to Feb 20, is a continuous line. You have peaks and valleys across the way, but it's virtually, an 11-year bull market that was up something like 4%. This bull market The scale on this is a little bit tough, but it's, what is it, like up 75%, or I can't really read this. Although I think we just said it's like 84, right? 84%. I could be
Right.
wrong. So the point of this is, hey, look, these are very similar. And one who is looking at this might say, are we only in almost to year three of a bull market? What if it continues for another, I don't know, 8 years from now to match the 09 20? I didn't have time, Mike, but I was curious to see the 1994 through, I guess it would have been March of 20. And that would be roughly, 6+ years, something right around there. I think there's a lot of similarities there, but I don't know. Is this a chart crime? Do you like this chart?
Eh.
Oh, all right. Negative. Fine. Tell me more.
I think one thing that maybe they have in common is the hated rally that I just mentioned. Um, I think in the beginning of that '09, the start of that rally seemed to be pretty hated. I think this rally right now is pretty hated. A lot of still cautious investors feeling the market could drop. I do think coming out of the '08 '09 crisis, a little different than measuring from October 2022 to current. Right, the market fell what double versus what it fell in October of 2022.
I mean, yeah, pretty much. I mean, I agree though. It's hated. It is a hated rally, and it reminds me. You brought up, this period back in 2013. There were a lot of individual investors, especially, who said, this is just a dead cat bounce. It's a bear market rally. Wait till it turns back. And it never did. Now, I don't know what's going to happen. You don't either. That's why we buy and we hedge. But yeah, I mean, I think it's convenient the way these two look. Although I wonder if we found other periods whether they would look similar. But I like Ryan Dietrich's work he puts out on Twitter. And okay, I'll buy it if you're bullish. This sort of validates what your thinking is, right?
Yeah, exactly. I think that it shows that the market this bull run could last a lot longer, I think, than people are anticipating. I just get the general feeling right now that everyone's waiting for the shoe to drop in the market to have its, scheduled correction that it's supposed to have. And it doesn't necessarily work that way. I think that this chart shows that these bull markets can last a lot longer than you think.
I mean, would a 10% correction be the worst thing right now? Not that saying we need a correction. I'm just saying, unless you need the money, and probably somebody who needed the money in the next 6 months should have already addressed that with their allocation. But I mean, a 10% correction, those happen all the time. It wouldn't be the worst thing. In fact, I'm sure in this chart from March '09 to February 20, yeah, I mean, I see 10% corrections in there just by eyeballing it, right? I mean, that wouldn't be the worst thing.
No, I mean, I think it would be due. It would just be part of a normal market cycle. So 10% from here wouldn't be very much at all.
There's a great quote by Peter Lynch. I'm trying to remember it. More money is lost waiting for corrections than in them.
Right.
That was, what year was that? I don't remember what year that was, and it's kind of right. I mean, you think about it. A lot of investors say, I'm going to sell out at the bottom. I'm going to wait. I'm going to get back in when the coast is clear. But anyway, all right. So you don't really like the chart, fine. But the point is, bull markets can go on much longer than people realize. We don't know when it's going to end. That's why we buy and we hedge. All right, let's talk about market cycles. Urian Timmer had put something out from Fidelity. And so he has the bull market, and his bull market figure says up 84%. We had a minus 28 bear market, and then we're up 84%. So this chart says the percent of stocks outperforming the index, meaning how many, what percentage of the stocks have a better return, a higher return than 84% over that period? Mike, it's only 35%. This is kind of that. It's really been driven by the Mag 7. And we call that market breadth. Like if 100% of the stocks were, well, I guess 100% of stocks couldn't do better than the index, but you know what I mean? Like if they were all outperforming really well, I think what the message here is, it is a smaller amount of stocks that are driving this bull market. And when you look and you see other periods, it's the tech bubble, the Nifty 50. So is this anything or is this nothing? Or shut up and take the gains. That's why you buy an index.
I think it's a good way to look at the concentration in the index. Do we care that it's concentrated? I mean, I think you should know that it's concentrated, but there's a reason that these stocks are as big as they are, right? They are their earnings speak for it. So I think another interesting part of this chart is during bear markets, you see a spike in companies outperforming, right? I take that
Oh,
to
yeah.
be there's a lot of companies in here that they don't perform as well on the upside, and so you would think that on the downside they're not going to go down as much, and that's exactly what happens. There's a flight to quality and value, so to speak, and I think that that's what you're seeing there as well.
I guess the inverse too could be that if you have a smaller amount driving the performance, if those all pull back and the other stocks don't pick up the slack, the other stocks, to your point, are going to outperform because it's those same stocks that got you the performance are now retracing. But
Right.
here's the other thing too. I mean, I'm just looking at this chart. You're in Timmer's numbers have minus 28. We were minus 35 in 2020. We were minus 20. What year was that? That was, so 2018? Yeah, that was the December, the near bear
Right.
market. So he's got 20 on here. Maybe that was intraday. I mean, so since 2018, how many years is that? That's 7 years. We've had 3 bear markets or near bear markets in 7 years. I mean, we've had bear markets. Like, I know everyone's waiting for, look, I don't know what's going to happen, but everyone's waiting for something to happen. And 43% of the years in the last 7 have had bear markets. It's kind of a lot. Like, we've had bear markets.
Look how quick they are. Look how short they are. I think that's part of the psychology of this is that these bear markets are so quick that investors forget they even happened. I forget they even happened. It just seems like the market has gone straight up. These bear markets they've been short in comparison. I mean, in general in history they're all fairly short, but these last ones look like blips on this chart.
March, 2000, 2001, 2002, that was a 3-year run where each year was negative. You see that in the max drawdown there was, they have it at 50%. They've got, so this must be price only, not total return, but it's 58% drawdown in 2008, 2009. That one was a little extended. I mean, that was 2008 extended to March of 09, the 3-year one. I think your point's well taken, though. A lot of these are very quick. I mean, that one in 2018, people even forget it happened. It
Yeah.
was basically the month of December, and I think it was Christmas Eve was the bottom, and then that was it. Then
Right.
the Fed, lowered rates. So, but if you're an investor, I don't know that these matter. And you have time in the long run, these don't matter. I mean, we like to say that we sort of mute the volatility and mute some of the downside because of some of the hedging strategies or buffered strategies, and that takes the need to be perfect on your timing out of it. But the other thing, did you notice too? So 84% is what they have us now. 119 was the prior one. So these were, the cumulative return looks like the price return up to 97, 106, 105, 169, 120. I mean, we're sort of above, a lot of these are 63, 65. So we're through those. But if you argue that, hey, we're going to go up to 105% or 119% before we stop, it's got more room to go.
Right. It's on the higher side, like above, what the average looks to be in terms of, a lot of 60s, like you mentioned, but there are multiple that are over 100. So this isn't like an unprecedented rally that we're in by any means.
Do you think that NVIDIA is the inflection point? So NVIDIA's August 27th. It's really the last monumental, I'll call it, company. And we've already had Apple, we've already had Microsoft. And so, I mean, has NVIDIA's earnings go? Is that how the market goes? It's kind of the last linchpin this earnings season, right?
Yeah, they are usually at the end of earnings. And I think if there's a big surprise on the downside, yeah, I could see a quick turn in this market. Um, of course, it's going to have a huge impact. It's the biggest weighting of the S&P, right? So, um, yeah, it'll be interesting to see how that goes. But I do certainly think it'll have an impact.
The lazy thing to say is that all the Mag 7, ex Nvidia, or all the big companies, they're all spending hand over fist on capital expenditures, capex, and it's all going to AI. And naturally, you'd think it all goes to Nvidia. If they were to miss, yeah, it would be. I think it would be painful. But I mean, we'll see. What happens is their earnings estimates, I think, for the forward 12 months are higher than any other time. The stock has continued to go up. Their forward PE multiple has come down. So in a weird way, even though the price is making new all time highs recently, their valuation has come down because the earnings have caught up. And it's one of the things I think value investors sometimes struggle with. If you look at how many times forward 10-year earnings some of these growth companies are trading at, you look in the moment and you say, well, there's no way they can grow into that valuation. But you go and you look at Google and Meta and Nvidia, Amazon. If you looked at what their, trailing 10 years ago PE is, or forward PE. So you look at what their price was 10 years ago against their 10-year forward earnings. I'll bet you a lot of them are under one, meaning
Yep,
they grew into the valuation. The valuation was probably right. So I don't know. Don't you think it's just, I feel bad sometimes for value investors. They're like, this shouldn't work, but it does.
it does. Yeah, these companies have continued to grow into their earnings, so they seem expensive because they've gone up so much, but the earnings justify it.
Didn't Nvidia too? Didn't they have like a 50% drawdown recently? I mean,
Yeah, one.
these companies. I think people forget that too. That not only do people forget about the bear markets we just talked about, that 42% of the time we've been in bear markets in the last 7 years, but you have Amazon, Meta, Tesla especially, Nvidia. I think Nvidia was down probably 50% at one point. Yeah, certainly, they probably were in 22 or 23, right? So,
I mean,
they're not,
earlier this year, it was, in the 90s, back in April. So,
so it was 50% lower than it was today. That
yeah,
wasn't necessarily a drawdown. What was the drawdown from the either December or might have been the August or July of 24 highs? But um, I'm asking you this question. I should have it up, but I don't. My charting program, Schwab, for whatever reason, if you don't hit a button in a certain amount of time, it logs you out. So it logged me out. All right, we'll come back to that. Let's talk about the top 10 company weights. So this is from Maverick Equity Research. Top 10 weight in the S&P is 39.73%. That is the highest weight going back to, I mean, this looks like it's from the 1960s. So 1960s, is this in 60s? Yeah. Yep. So I don't know. It's high. I don't know what you want me to tell you though. I don't know what to do with this.
Does
It's
it matter?
well, it matters if there's not another company that comes up to challenge them.
Right.
And you think about it, that's what happened with Nvidia. Nvidia came up and grew into that top 10, grew into being the top weighted stock in the world, or certainly in the S&P 500. If there's not somebody who's on the rise, maybe it does matter. Like imagine if Nvidia started missing earnings, or the growth forecasts weren't as big, or maybe there's a company that's not public that all of a sudden figures out a new way of doing that. I mean, that's definitely a risk, but I don't know. I mean, you got the benefit. Like you can't have the pain without the gain here.
Right.
And because you own the index, you've gotten all these outsized gains because all these big stocks are driving it. But I don't know. All right. Anything else on this chart? We're good with it, right?
Yeah. Good with
All
it.
right. I want to make fun of Wall Street analysts because it's very easy to. There was something in Yahoo Finance that said Wall Street forecast revert back from tariff turmoil. So what I'm looking at here is their initial forecast. So imagine this: start of the year, some of these firms said, "Oh yeah, the market's going to end the year at 7,000, 6,800, 6,600, and change." And then what happens? Well, we have the tariff tantrum, and they all lowered their year-end targets. So I'll pick on Oppenheimer for a second, just because it's easy for me to read. And Oppenheimer has the top, looks like the top forecast. So they probably were around 7,000. They're now 7,100 as a year-end target, according to this Yahoo Finance. It looked like they lowered their year-end target to something around 6,000. The reason why I like to make fun of this is, like, number one, who is this helping? And number two is, like, if all you're going to do is just follow the market, like, oh yeah, the market's down, so we'll lower our forecast. The market's up, so we'll raise our forecast. And I think it just calls into question why they're even doing forecast at all. All right, I'll stop there. Any comments, Mike?
It's something you see on a headline if you're watching the local news. Bank of America drops year-end forecast without any real context. And I just think it goes to it's very difficult to predict where these markets are going. We don't pretend to know where they're going, and like you said, that's why we do things that give you, more certain outcomes, right? Like things like buy and hedge to reduce volatility and understand where your risk is, because these markets are unpredictable, and we don't try to guess where they're going to go.
Who was it last year? Was it Morgan Stanley? Might have been Morgan Stanley. The guy, the analyst there, I think he stayed really bearish. Like his year end target, he never moved it, and it wound up being any multiples lower than the actual market. I can't remember who it was. Was it Mike Wilson? Was that the analyst? I think maybe it was the year before. Maybe it was 2023. I'm thinking of. Maybe I think it might have been 2023. So, all right, look. I mean, I like to make fun of this because I can, but to be fair to them, it is really difficult to give a forward estimate. Like if you ask me today, what's the market going to be in a year? I would say, hey, tell me what the forward 12-month multiple will be, and tell me what the earnings estimate is over the next 12 months. One year from now, what will the next 12 months earnings estimates be? And then I'll try and guess what the market multiple is. So even if you had the perfect earnings forecast of what they'll be in a year, you still have no idea what the multiple is. How many is it going to be? 19? Is it going to be 20? That matters. So I think we're 22.6 right now, forward estimates. People say that's high. It's not low. And I certainly think the market would be hard pressed to get to a 30 forward PE, but I don't know. Is there any reason why we couldn't stick here for a while? Who knows, right, Mike?
Yeah, I mean, um, when someone asks me where's the market going to be, I generally will, a lot of times I'll look at the options market and provide a range, right? That's how difficult this is to tell someone where the market's going. Like I like to look at the money options and look at the premiums and provide a range and say, this is what the market's pricing in. If you think markets are efficient, this is a good way to think of it, and provide a range of where it could trade.
Let's talk about that for a second. I'll do this on the fly. So, for example, if I look at the S&P 500 index options, August 21st of 2026, they're about 300. Well, they're not about. They're 377 days away. It is. I mean, that's 12 days over a year. So, if you wanted to look and say, okay, a year from now, will the market be 7,000? And we can go in and we can look at the 7,000 strike and the options market. The probability of expiring in the money is what, Mike? Is it, do I see 27? Is that what I'm seeing there? 27 and a half?
For the 7,000, August 21st,
Yeah.
I am seeing 36.
August 21st, 2026.
Hold on.
Why do I see a different number? I see 27.57 as the probability of expiring. That means probability expiring in the money. I'm just looking at Think Pipes on Schwab. The probability of touching I'm showing is 56.3%. So the difference between those two numbers, as you're kind of looking at your screen, the probability of touching means it might touch that level, but it doesn't necessarily stay at that level or above. The probability of expiring, the options market is saying it's about a 27.5, based upon what I see, 27.5% probability of expiring. 7,000, if you look at the 7,000 level, we closed at 6389.45 today. I mean, that's only 9.55%, 9.56% higher than we are. So, I'd say the options market is telling us it's a 50-50 coin toss whether we get there.
Right.
So, I don't know. I mean, that's what the option market is looking at. What way do you look at it? Do you look at it at some different metrics?
That's one thing I would look at. The other thing is I like to just look at the money options and look at what they cost and provide what the priced in trading range is for a period of time. So instead of giving a directional view, say this is the range that the market's expected to trade in based on how expensive or cheap the options are being priced.
So if I look right now, the 6400s, there's no perfect one on here.
Yeah.
But if I look at the 6400s, so those are, they cost 500 and we'll just round up $540 right now. So if you bought that, your break even is 69.40, right? That's sort of your break even from here.
Right.
So, yeah, I mean, you kind of look at that aspect, right?
You could take it a step further and say, what are the puts trading at? Right. The puts, let's just also call it 5. The puts are
327.
327.
Yeah.
So you're getting a total, if you were to buy that call and that put, $867. So it's sort of a range. You can say that is being priced in both, if you want to put a band around it, an $867 band that the options market's pricing in based on the money calls and puts.
For the audience too, because I know we have a lot of listeners who pay attention to the gamma, the gamma in the options market maker books. Mike, if I bought one call option, well, this is index. I really should do SPY. But imagine this was SPY and it's a 50-ish delta. I buy one contract of SPY. You're the market maker. You're selling me that call. I'm buying the call. How many shares of stock do you need to buy to hedge?
Say that again.
50, let's say a 50 delta. I'm buying the 50 delta call. You're selling me that call to hedge how many shares of stock you need to buy.
50.
You need to buy 50. Yep. So that gets back to some of the options activity that we look at. We say, what's on the market maker's books? What's going on with the flows? And you can say, is the options market, is it driving prices higher? Meaning if there's more put or more call buying than put buying to a greater extent, and the market is going up, does that cause a little bit of a what's called a gamma or a delta squeeze? And you got to buy, the market makers are forced to buy more stuff. It works the other way too. But yeah, I mean, look, it's the market saying you have about a 50-50 shot of getting to 7,000 in the next year. I'll let you know in a year whether that happens or not. But,
Mark the
that's,
calendar.
I will. Did you say, is it going to 7,000? Did you take that bet or no?
I don't think I did.
I think it will go to 7,000. Do you think it goes to 7?
In a year?
Yeah. I think it hits there. I don't know if it stays there.
Yeah, that's what I was going to say. I think it'll touch 7,000 in the next year.
Okay. Fair enough. We'll probably both be wrong. So don't trade on that, everybody. Don't.
That's why we hedge.
That's why we hedge. That's right. All right. Let me go on to. I want to talk about the mess that is the BLS. And as we know, President Trump decided to fire the head of the Bureau of Labor Statistics, or BLS, as we call it. So I may have touched on this last week. Basically, the survey participation rates have been dropping. And when you have lower participation rates, your quality of the data can go down. And there was a big revision. So what happens is with the surveys, and I'll repeat this again, is there's a household survey, there's a business survey. In the business survey, businesses are contacted and they're asked, you're hiring, you're getting rid of workers, you're, all the different types of questions. And then there's the household survey. The household survey is they call people and they say, are you working? Yeah, I'm working. Great. You're employed and you're part of the workforce. Next person, are you working? No, I'm not. Okay. Sorry to hear that. Within the last 4 weeks, have you looked for a job? Yeah. Okay. You're part of the labor force and you're unemployed. They call the next person. They say, do you have a job? No. Sorry to hear that. Have you looked for work in the last 4 weeks? No, I'm good. I'm going to try poetry for a living, or I'm going to go walk around go on holiday for a while. Okay. You're not unemployed and you're not part of the labor force. So that person is, and they do those surveys. So what's happened is the average differential between the final estimate of non-farm payrolls and the initial estimate. And there are periods where payrolls are revised up. There are periods where payrolls are revised down. And there's been 30 consecutive negative revisions to payrolls. So that's almost, 2 years is 24 months. So two months or 2 years and 6 months, they've been negative. Some of this stuff I think gets a little skewed from, the 2020 and the COVID period and all that stuff. I think we can say that now and not get the Joe Rogan banner on Spotify, but we'll see. So the reason why this is a big deal is they're basically saying if the revisions are so wide, what's the problem with the data? And when you look, the revisions are sort of equal to, when you look at the 30 months prior, take out the pre-COVID and the post-COVID. They're similar to many of the revisions upward that we see. The largest revision downward is probably the 2008, 2009. And when I say revisions, it's basically you're calling people, you're taking surveys, you extrapolate some data out of that, you multiply and figure that's a good sample size. Could they be doing these things differently? Yeah, probably. And the response rates aren't there. And I don't know if it's just tougher to reach people or if businesses are like, I don't have time for this. There was periods too, if you Google it, I think it was back might have been 15 years ago, where there's a lot of pressure on the people, the BLS, the workers there, and I think there were instances, I don't know how widespread it was, where they were basically making up some numbers. They were incented, or they were under, they were getting reviewed based upon the number of people they contacted, and they couldn't find people. I think they were just making it up for some. I don't know that still goes on, but all right. So all this said, the reason why there's revisions is because you go to surveys and then you go to the actual state data. But if we had to wait for the state data, we'd have to wait like 6 months or even longer to get the numbers. So I don't know, Mike. Are you a candidate to lead the BLS? Let's first get that out of the way.
I'm
Any
not.
interest there? Okay,
I'm taking my name out of the running
you're taking your
officially.
okay. Good to hear. I've also taken my name out of the running. So now that we got that out of the way, I mean, when you look at this chart from revisions, the size of the revisions up and down, I mean, I don't know. I mean, it seems like there's a lot of periods where the revisions are higher. It just happens to be lower now. Like, what's going on here?
I think maybe the only people answering phones are people that are hiring and are running successful businesses. I don't know, right? Like if it's just people, they're just talking to people who are hiring, and the people that are out of work, right, aren't picking up, then maybe that's why they're revised lower the next month. I don't know.
There is an immigration angle here, and Goldman Sachs, I think it was Goldman Sachs, had a report, and they felt like some of the discrepancies between the initial surveys and the final state numbers might have been because of some of the immigration impacts. If I find it, I'll put it in the show notes. I don't know. I mean, I just feel like it used to be revised up. Now it's been revised down. I guess the reality is I'd be interested to see just a chart of the final numbers. And really, if you had a chart of the final numbers, you could backtrack. But look, I mean, economic data gets changed all the time. There's seasonal revisions. I don't know. I mean, does this mean the Fed cuts though? That's really the thing. I mean, and didn't the Fed know this? I mean, this came out the day after the Fed meeting? Are you kidding me?
Right.
They didn't have this?
Right.
All right. Well, nothing there, Mike.
That's all I got on this one.
All right.
I'm at a loss. I don't know. I can't tell you why it keeps getting revised lower. I wish I knew.
Employment's usually the last thing to go. Like you don't what is it? It's hope, housing, orders, profits, and then employment. Uh was it Michael Cantrell came up with that? I think that's who came up with it. And what that means is a lot of times, like, you don't necessarily see employment coming. All of a sudden, you start to see the job losses. So I don't know. All right, let's move on then. Fine, you don't want to talk about it. That's fine. What about rent? So the Macro Institute has a chart, and it says yes, another first for economic data series this year with a big exclamation point. And what they do is they look at the Cleveland Fed new tenant rent, the 9-month year over year, and then we have the Cleveland Fed all tenant rent year over year and CPI rent year over year. And audience can't see this, but Mike, you can. And basically what it's saying is new tenant rent is down close to 10%. And it's really been diving lower. I mean, it's been on a downtrend. So they put in the chart, not sure what to make of this, question mark, exclamation point, question mark. They're really serious about this one. I don't know. I mean, CPI is, it seems like if this is true and some of this stuff gets revised, is the cost of housing really coming down? And i.e. CPI is going to come down? Like, I don't know. What do you make of this?
Yeah, I mean, look how much. If you look at this chart, how much the new tenant rent went up in 20. It looks like end of 2021 and 2022.
Mm.
I mean, is this just the income of renters not being able to keep up with that amount of increase in new rent, and just sort of a reversion back to an average level?
Or was it? I think it's really astute that you. There you go. I just called you astute, Mike. It's very astute that you pick that up because I. It's almost like, are we having a reversion to the mean? Is it just a snapback from that? And if you were looking at this, you would see that CPI, all tenant rent, new tenant rent is all kind of mashed together. Oscillating here and there, and then you get this massive. I mean, it spiked to probably, I'd say, 12.5% year over year. So there was something that people and think about what was happening. We were sending money out. So you have more supply of money. People have more money. It increases the ability to pay for things, and you have inflation. So I don't know. I mean, it feels like it's a snapback, but does it just wind up back where it was prior? I guess that's the question. Are we going to see that 2.5% ish long run average? I don't know.
Yeah, or does it keep dropping?
This looks good for inflation, though, and if you look at this and you believe the CPI rent is lagging, like it didn't go up until we knew home prices were going up. We knew apartment prices were going up, rent prices were going up, but it took a while for CPI to reflect that. I mean, if I'm looking at this, unless we get a jump in oil prices, this is a big component of CPI. And do we get to below 2% at some point if this is true? I don't know. What do you think?
Yeah, below 2% in rent. Is that
No,
what
no,
you're
it's
saying?
2% CPI. Like, is this
Oh,
forecasting? If it's lagging,
yeah, yeah. I mean, it looks like it does lag. So certainly, I mean, it looks like even without rates being lowered, it could just naturally come down based on you know uh, people naturally tightening.
I did see that home prices, I think we talked about this last time you were on. Home prices are steady. There are more buyers. There's more sellers than buyers now. And but I mean, I feel like home prices, for all the doom and gloom, and if you go watch YouTube and you Google on or YouTube search home price crash, like they're all over the place. And I don't pretend to, I don't think you're an expert either in home prices or that type of stuff, but it's another example of where the crash that's been talked about on YouTube has not materialized. We'll see. I mean, I'll let you know in a year, but it's so far, I mean, there's a lack. I think there's more supply that is not coming onto the market. There's definitely a lack of buyers because of interest rates, but and if this rent is coming down and if people can't buy houses, that seems to be pretty good too. So
Well,
I don't know.
yeah, there's multiple levers in play, right? There's less supply. There's more, but where interest rates are, it's keeping buyers, um, in their homes currently. So there's not a ton of buyers uh, at the same time, but because of that, there's also less supply, right? People aren't moving; they're not putting their current homes on the market. So there are sort of multiple things that are helping and hurting the market. That's sort of stabilizing it, I think.
Here's a public service announcement too. If you're someone working with an advisor and you have one of those, mortgage that's like in the 2% range or 3%, and you're thinking, oh, I should totally pay off my mortgage. You should talk to somebody first because it might not be the best idea. You got to work through the pros and cons. But essentially, if you have a sub 3% mortgage right now, you're paying less than the rate of inflation, although we said maybe it comes down. I'll let you know when that, if it does or it doesn't. But put it to this way, the cash, let's say you just had cash and you had it in 3-month treasuries earning 4.3%. To sell your treasuries to pay down your mortgage is a you're making more in the on your cash than you're paying in the mortgage interest. It also depends on where you are in the life of the mortgage. Later on in the mortgage, you're paying more back to yourself and principal. So it's not, just that's a public service announcement, Mike. Just people should talk to their, someone who knows something about this stuff, maybe their advisor, to get some clarity there. Don't go out and buy speedboats with your cash, because that's probably going to be a worse return than paying down your house. But all right, Mike, let's talk about Nvidia. We're still 21 days or 19 days away, I think, from the expected earnings, but it's not too early to start looking what the options market is telling us. Nvidia closed today at 182.70. If I kind of look at the 180 and the 185 calls for August 29th, that is the nearest expiration to earnings where the contract will still be live. I mean, right now the implied volatility is, I'll kind of split something like 46%. So I don't know. I mean, I feel like closer to earnings that probably goes up, but I mean, we're far enough away from earnings that's not really impacted yet. But it's in there. It's in the chain where, if you're looking at, when I say the chain, different month expirations, this chain has the highest amount of implied volatility. When we think about what a 46 volatility means, we say, well, if you want to know what the 1 day expected move is, you take 46 divided by the square root of 52, which is 15.875 ish, and a bunch of numbers. And it says right now, basically, it's 2.89 or 2.9 if you round it. Well, we have 21 days to go. So the square root of 21 is 4.58. What did I just say was the expected 1 day return?
2 point something,
2.9. There you go.
2.9.
Yeah, so a one standard deviation move that the options market is pricing in over the next 21 days is about 14.3%. Up or down, it's kind of a range. So that's kind of what the options market's saying. And if you think about that, another way, Mike, you probably look at it is I imagine you might add up the call and the put. So let's look at, this is kind of right in the middle. So I'm going to say, imagine we bought a 180 put, and that put is about $6.50, and we bought a 185 call, and that's about, $7. I'm rounding down just to make it easy. So it's about 13 and a half, and 13 and a half on 182 is, does that check out with kind of what we just said? It's about 7.4%. But remember, that standard deviation is up or down. So I don't know. I mean, it's not in the chain. It's not in this expiration yet. I'd expect that right before earnings, you'll see more volatility. But I mean, on a relative basis, 46 is it's a higher implied volatility stock, right?
Yeah, it's definitely high. I mean, let me ask you this: as Nvidia keeps growing, do you anticipate volatility in this stock coming down?
Yeah, I mean, you look at Apple. Apple's a good example of where, and if we look at that same expiration, there is, looking at the implied volatility, it's more like 25, 26. Now, they don't have earnings, to be fair enough. But if we go back to Nvidia and we just say, let's look at the earnings, the post earnings expiration, the regular September, and the at the money there option is 42. So I would say, yeah. I mean, think about, Mike, when a company, Apple, maybe it's not growing as much anymore, but it's sort of its expectation of growth has matured. So yeah, I would say yes. What do you think? Yeah.
Yeah, I think so. And if you look at options before earnings, right? So trading, they're going to expire before the earnings are announced. You look at the the 185 for August 22nd, for example, that volatility is just under 30.
Yeah, that's right.
So yeah,
I
I think
mean,
the expectation. I mean, when it if it continues to grow, the larger it gets, I would anticipate volatility at some point coming down. Now there could be something beyond AI that we don't know about that you know kicks growth up again. But yeah,
Tesla is an interesting one because Tesla, I think, has had more downside volatility than many of these stocks. But Tesla, you look at the August 29th, the same expiration, you look right around the money. And there, the implied volatility is closer. It's more like 43, 44 right there. So, yeah, I mean, Tesla's, I would say they are more volatile in general because of the news cycle, because of the business they're in. And they're definitely an AI company. But yeah, I mean, Apple's a good example. Apple is more, I mean, they're kind of more of a steady state company. A lot of the revenues come from services, meaning subscriptions and ongoing service, things from the App Store. I'll probably buy the new iPhone because I buy the new one every year. Can I be honest with you? If I didn't buy last year's iPhone, the newest one that came out, I probably would have been just fine. I don't really see any different, and Siri is still not helpful. But I don't know.
you keep buying it though.
I do. I don't know why. Maybe this year I won't. Maybe I'll. So, all right. I think, I mean, here's the thing. August 27th is going to be, and I say this every time, like Nvidia is really going to be important, but it's possible too that they come in basically what the analyst expected and they guide what the analyst expected. And it's sort of a non-event. I mean, it doesn't have to always go up 20 points or 20 points down, you know? So I don't know. We'll see what happens. All right, Mike. Any recommendations for the audience? I mentioned this last time we were on. I've completely stolen this from Barry Ritholtz when he does his Masters. What's it called? Masters in Business podcast. I think it's Masters in Business from on Bloomberg. He asked the guest, "What are they reading, watching, or writing?" Or I guess, well, you could be reading and writing. So, any recommendations for the audience?
So I've been pretty busy getting moving, but I have watched one movie in the last 2 weeks. I don't know that this is a recommendation, but Happy Gilmore 2. I did watch it. Very dumb, but if you're in the mood for a dumb movie and you enjoyed Happy Gilmore 1, you might like it.
Are you an Adam Sandler fan?
From the 90s, and early 2000s stuff, but nothing recently that I've really liked.
It's amazing too that all of his movies they always have like the same people.
Yep,
So it's the same cast of characters. Even like Dan Patrick is in there all the time, which is kind of funny. So I haven't seen it yet. I've heard people tell me if you watch the original, it's like a check in of all the characters, but I haven't
exactly.
heard great things about it. So we'll see. I watched a show called Untamed on Netflix, and I thought it was good. I thought the acting was good. It was kind of a surprise where it went. I felt like it could have been a movie instead of a series. It could have just been a movie. I'm not. I'm giving it a market weight. I'm saying it's not on my conviction list. Um, it's somewhere between a hold and a buy. How's
Okay.
that? Have you seen that?
No, not yet.
I mean, I think it's pretty good. And then Shane mentioned this last week. Baseball season is definitely, we're getting to that point where every game sort of matters in the standings. So I've been checking in on the different races in baseball a little bit more. And as a Cub fan, I know that you are looking up at the Brewers now. So
They
not
don't
looking good for you
lose.
guys.
They do not lose.
They
Every
only
night
win.
I check in on their scores, and they're on a tear right now. So I think, like, if you would have asked me 3 weeks ago, I would have told you the Cubs are going to win the division. Now it's I'd flip to almost certainly a wild card spot. So it'll be interesting. We'll see how it plays out.
Have you ever been to Fenway?
I've not.
Like Fenway, Wrigley. I mean, Dodger Stadium is one of the older ones too, but those are really the three. And I think, Wrigley is very, very unique. Fenway's unique. Dodger Stadium is. But I was just thinking about this the other day. Like, there's really no old ballparks. I mean, even the one in Arizona, which you guys were out here and we went to a game, that park opened in '98, which I can't believe it's, what is that, 28 years ago, 22 years, 27 years ago, right?
Wow.
That's kind of an older park, but there's no Tiger Stadium. It's the old Municipal Stadium from Cleveland, old Yankee Stadium, Shea. I mean, I'm kind of looking at the standings, and I know the Angels rebuilt their stadium or refurbished it. The Twins have a new stadium. I mean, White Sox, right? White Sox opened probably in the '90s, so that one's actually pretty old, but pretty old relative. I mean,
Right.
so all right. I mean, Wrigley's definitely a unique place. So if you haven't, I'll recommend going to Wrigley. How's that? If people have not gone there,
That's a
it's unique.
strong buy.
That's a
Yes.
strong buy for sure. I would not necessarily make the trip to go to New Comiskey, and they built that just before the cool ballparks were coming in. I think Baltimore was the next one built, and Baltimore did that cool thing with the warehouse, and Comiskey's just kind of boilerplate to me.
Yeah. I've been a few times. It's been a while, but not much unique about it. So.
I mean, I probably went to Shea Stadium for the Mets more than you've been to Comiskey.
Yeah, I bet that's the case.
I didn't hate the Mets. I just hated the Red Sox. All right, so we'll wrap there. Next week, is the market up or not? Give me a prediction. I want the exact number of the close on Friday.
I'm gonna say the market is up, and let's go.
I was kidding on the exact number. I know the exact number. Look, who knows? Who knows? I mean, the CPI is the big. All right, so CPI is the thing next week. If we just get the print that's expected, I think it's a non-event. But right now, are we going into one of these bad news is good news? Like the jobs revision was down, and the market rallied on that because they say the Fed's going to lower interest rates. So
Right.
I think if the CPI print somehow comes in under the expectations, I think the market really reacts well to that. If it's higher, it's going to be mad again because it's like, oh, we want things to go bad so we can lower interest rates. So
That's
I don't
right.
know. I was joking about we used to do these presentations live, and I would say, okay, do you want the single best time to place a buy order? And everyone's like grabbing their pens and they're writing. I'm like, I'm kidding. I what do I know? So, all right.
I had a number for you, but if you don't want it, then
No, give me the number. I want the number.
I'm just kidding.
You got that? All right. No numbers. All right, everyone. Thanks for tuning in. Send us emails, derek.moore@zegainvestments.com. That's derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple. You got to figure out how to spell investments on your own.com. All right, Mike, thanks for coming in, and we'll be back next week. Take care.